Hello friends. Friends, we'll continue with cash flow statement, right? And in cash flow statement, we have been discussing about cash flow from operating activities, right? Cash flow from operating activities, right? So we have discussed about how to calculate cash flow from operating activities, right? In steps we have discussed that first of all we calculate the net profit before taxes and extraordinary items, right? The second step, we adjust the non-cash and the non-operating items, which include depreciation, which include goodwill amortization, loss on sale of fixed assets, profit on sale of fixed assets. So everything related to that we adjust. Then after that, we make working capital changes, right? After the working capital changes, we get the cash flow from operations, and from that cash flow we deduct income tax net of refund. Clear? And we adjust extraordinary items. Now, one important point we are going to discuss in this lecture is about fixed asset account. Fixed asset account. Right? Now, can you tell me the one item related to fixed assets that we deal with in cash flow from operating activities? One item related to fixed assets that we deal while calculating the cash flow from operating activities. Think of it. That one item is depreciation, isn't it? Where we deal it? Depreciation is a non-cash item and we add back the depreciation for the year. Clear? We add back depreciation for the year to the net profits before taxes and extraordinary items, isn't it? Now, if we are charging depreciation on fixed asset, let's take an example. Let's say you have fixed assets. You have a fixed asset of rupees 1 lakh appearing in the balance sheet. And you have to charge depreciation at the rate of 10%. Now, what is the amount of depreciation? Amount of depreciation is 1 lakh multiplied by 10%, that is rupees 10,000. Can you tell me the journal entry for this? Journal entry for charging depreciation on fixed asset. Can you tell me the journal entry? Very simple. If we are reducing the value of an asset, that asset will be credited, and what will be debited? Depreciation, because it is our expense. So what will be the journal entry? Depreciation account debit to fixed asset account. Clear? Clear? Now in the balance sheet, your asset will appear at, if you look at the balance sheet, your asset will appear at fixed asset 1 lakh minus depreciation for the year 10,000, and your fixed asset will appear at 90,000. Clear this much? You are charging depreciation on the fixed asset, you are reducing the value of a fixed asset. So in the balance sheet, your fixed asset will appear after charging depreciation. The journal entry will be depreciation account debit to fixed asset account, because depreciation is our expense. Clear? So now, one important thing to see here is, sometimes what people decide is to show the asset at their cost. Asset appearing in the balance sheet, asset appearing in the balance sheet at cost. Then sir, what to do with the depreciation? What they do is, the depreciation every year is charged to depreciation every year is charged to provision for depreciation or accumulated depreciation account, right? So what is the journal entry in this case? In this case, the journal entry is not depreciation to fixed asset. We are reducing the value of a fixed asset, no doubt, but in the books we will show the fixed asset at cost only. The journal entry will be provision for depreciation account debit to fixed asset account. Instead of depreciation, what we are doing is, we are charging it to provision for depreciation account, right? The fixed asset will appear in the balance sheet at cost, and in the balance sheet you will see an account with the name of provision for depreciation. Clear? Right? So now, what is the role of all this in the cash flow statement? See, in the cash flow statement, we need the depreciation amount, right? If you are given some information related to fixed asset and you are given provision for depreciation, then from there you have to derive the value of the depreciation charged during the year. From this provision for depreciation account, we will derive depreciation. What we are derive is, we will derive depreciation charged during year. Clear? This is what we will derive. We will derive depreciation charged during the year. Clear, friends? Now let's see this with a practical problem. Okay. Says calculate cash flow from operating activities from the following information. Surplus, that is balance in statement of profit and loss account. You are given the opening balance and the closing balance, right? First is the surplus, then general reserve, provision for depreciation on plant. We are given not the depreciation, we are given provision for depreciation. Clear? Outstanding expenses, then goodwill and trade receivables. Then the additional information says an item of plant costing 20,000 having book value of 14,000 was sold for 18,000 during the year. They say there is an item of plant costing 20,000 but its book value is 14,000, was sold for 18,000. You have provision for depreciation account. That means you have to derive the value of depreciation charged during the year from this account. For this purpose, we will prepare two accounts basically, right? So let's see how to prepare these two accounts. First, we will learn how to prepare these two accounts, then we will do the simple question. Okay, let's see. One second, guys. Okay, let's do it. First of all, what we are going to do is we are going to prepare fixed asset account. Clear? We are going to prepare fixed asset account. Now, what is the opening balance? I can say, they say the fixed asset costing 20,000. So the opening balance of fixed asset was 20,000. Clear? This asset is sold for 18,000 by sale. Journal entry, sale to fixed asset. So I can say by sale 18,000. Now see the question. It says an item of plant costing 20,000 having book value of 14,000 was sold for 18,000. Now the difference between the cost of the plant and the book value of the plant, we purchased plant for 20,000. Now the book value is 14,000. What is the difference between the two figures called? This is the amount of depreciation that has been charged over the years. This amount reflects the amount of depreciation that has been charged over the years. Clear? So what does this amount reflect? This amount reflects the amount of depreciation that has been charged over the years. And now, as I told you, if you can see the provision for depreciation account, all this depreciation was charged to provision for depreciation account and not depreciation account. So I can say by provision for depreciation. Clear? Account how much? 6,000. How the 6,000 is arrived? 20,000 minus 14,000. The difference between the cost of the asset and the book value of the asset reflects the depreciation that has been charged over the years on that asset. Clear? And that depreciation has been debited to provision for depreciation account and not depreciation account. Clear, friends? This much is clear. Then what is the difference? The book value of the asset is 14,000 and you have sold it for 18,000. So you have a gain of 4,000, isn't it? You have a gain of 4,000. So I can say to gain on sale. What is the amount? 4,000. Now this account has tallied 24,000. If there had been a balancing figure, then how we would have dealt with that, we will discuss while doing cash flow from investing activities. There also we will prepare this fixed asset account. Here we are preparing to ascertain the amount of depreciation, because that is the main point regarding the fixed asset that we use in operating activities. We need depreciation. For that we will use provision for depreciation, and for that we will use fixed asset account. Right? Now to ascertain the depreciation, we will prepare provision for depreciation account. Clear? Just remember one thing. When you are given the provision for depreciation account, you have to prepare the fixed asset account and the provision for depreciation account to ascertain the value of depreciation charged during the year. So the provision will have the balance on this side, credit side, by balance brought down. What is the opening balance of provision? He says provision for depreciation on plant, opening balance was 30,000 and closing balance is 35,000. So the opening balance is 30,000 and I have the closing balance to balance carried down, that is 35,000. Now you see we have the accumulated depreciation of 6,000, that is the depreciation that has been charged over the years has been accumulated and debited to provision for depreciation account. From this I can bring the entry here and I can say to plant account, that is our fixed asset account. How much? 6,000. Now what is the balancing figure? The balancing figure is the depreciation charged during the year. Clear? That comes to 11,000. Clear? So for identifying the depreciation charged during the year, we have to prepare provision for depreciation account. It is prepared only when we are given the balances of provision for depreciation account in the balance sheet. If it is not given, that means the depreciation has been directly charged. Clear? So this is the main concept of fixed asset. If the fixed asset is appearing at cost in the books and you see provision for depreciation account, then for the year, what is the depreciation charged will be calculated from provision for depreciation account. Clear? How we reach at amount of 6,000, is it clear to you, friends? Right? 6,000 is the depreciation charged on plant over the years and that has been debited to provision for depreciation account. Why? Because the plant was to be shown at cost in the books. Clear? I hope this much is clear to you. Now, can you prepare cash flow from operating activities? Now you have all the information. You can prepare cash flow from operating activities. What you are given regarding the net profit? Regarding the net profit, you are given the surplus in the balance sheet opening and closing. So I told you how to calculate. I'll say closing surplus that is 35,000 minus opening surplus that is 30,000, right? So this is net profit for the year. Anything related to the net profit that we have to adjust here? General reserve. Do you adjust general reserve while calculating the net profits before taxes and extraordinary items? Definitely yes. Why? Because general reserve is nothing but the part of profits only. We have set aside the profits, right, to meet any future contingencies. So that is the general reserve. So we will add back the amount that has been transferred to general reserve. See the amount. Opening balance was 10,000, closing is 15,000. That means during the year you have transferred an amount of 5,000 to reserve, right? Sorry, this comes to 5,000. Then we will add back transfer to general reserve. How much? 5,000. So what is the net profit before taxes and extraordinary items. What is the net profit before taxes and extraordinary items? This is 10,000. Now we have to adjust non-cash and non-operating items. Clear? We have to adjust non-cash and non-operating items. So what are the non-cash and non-operating items? Provision for depreciation on plant. From here we have calculated the depreciation that has been charged during the year, which we are going to add back. Add depreciation charged 11,000. You see, you have prepared this fixed asset, or we can say plant account, and provision for depreciation account. Show this as working notes. Okay, and give the reference of working note here. You can say working note number 1. Clear? This way you can show. Okay. Now, what else is there? Outstanding expenses, no. Goodwill. The amount of goodwill has decreased. Goodwill is a non-cash item. The amount of goodwill has decreased from 20,000 to 10,000. That means we have the goodwill written off, or we can say we have goodwill amortized. How much? 10,000. So this we will add back. Anything to be subtracted here? If you see the plant account or the fixed asset account, you see the gain on sale of fixed asset. You deal with this while calculating the cash flow from operating activities. The sale of fixed asset, sale of plant is not an operating activity. Therefore, the gain we will subtract from operating profit. Subtract gain on sale of plant. How much is the gain? 4,000. Clear? So can you tell me operating profit? What we get is operating profit before working capital changes. Right? How much is the operating profit before working capital changes? This comes to 27,000. Now we will do working capital changes. Right? Some items we will add and some items we will subtract. I've left some space so I can adjust the items, right? So what are the current asset and current liabilities appearing in this information? Surplus we have dealt with, general reserve we have dealt with, provision for depreciation we have dealt with, outstanding expenses. This is a liability. Your liability of outstanding expenses has decreased from 5,000 to 3,000. Right? Outstanding liability, your current liability has decreased from 5,000 to 3,000. What you will do? The current liabilities move in which direction? Current liabilities move in same direction. If the amount of liability is decreasing, then we will subtract that decreasing amount. How much it is? 2,000? From 5 to 3, yes, 2,000. Clear? Then, goodwill we have treated. Trade receivables, sundry debtors. Your sundry debtors have decreased from 40,000 to 35,000. That means you have recovered the amount to the extent of 5,000. Right? If you have recovered the amount, your cash from operations will increase. Your debtors will decrease and your cash will increase. If the cash is increasing, we will add back. The other thing is, I told you that current assets move in opposite direction. If there is a fall in the value of a current asset, we will add back that current asset. So I can say sundry debtors, I will add back 5,000. Clear? Now we do not have any information regarding the taxes or anything, so I can say this is what we say as cash flow from operating activities. Clear? This amount comes to 30,000. Clear, friends? The main point here was the preparation of the fixed asset account and the provision for depreciation account. So just remember one thing, if you see the provision for depreciation account, then one thing you should always keep in mind is you have to calculate the depreciation charged during the year from provision for depreciation account. Second, it means that the fixed asset has been shown in the books at cost, right? All the depreciation has been charged to provision for depreciation account. The journal entry is provision for depreciation to plant account or fixed asset account. Clear? Clear, friends? So you will prepare the fixed asset account, you will prepare the provision for depreciation account, and from the provision for depreciation account you can calculate the balancing figure will be the depreciation charged during the year. This is your balancing figure. Clear? So rest of the question was quite simple as we have been doing. Clear? So in the next lecture, we'll discuss something about provision for taxation. Right? You might say that, sir, we have discussed that this provision, current year provision, we have to add back, and the previous year provision we have to consider that we have paid income tax this year. Yes, that's true. But sometimes the information is given in such a way that you have to calculate the amount of provision created or you have to calculate the amount of tax paid. Clear? So, how to act smart in those cases? You have to prepare provision for tax account. So that's what we are going to do in the next lecture. For any queries, friends, you can always email me. You can always send an email at ksjteaching@gmail.com. Clear? So that's all for this lecture, friends. Thank you so much.